This is what the banks do not want you to know. I am $15,278,000 in debt. Yeah, you got to do your PFS every single year and you figure out how much more you're in debt. And there's really two types of people in this world that understand debt and the ones that don't understand debt. And this is what the banks do not want you to know. There's in these two types of people, and these two types of people see the world very differently. And I'm talking about savers and people who like to use debt. So you have two forms of people here. So the borrowers of the world, though, understand how the banks make money, understand how the banking system works, understand how to get really wealthy. So in this video, I'm going to kind of teach you a little bit about, how to set up your life so you're not living with liabilities. Instead, I see my debt as a cash flow machine for me, and I leverage to get higher returns on my money, which when you're very young, you need to get the highest returns to get that compound effect for your future wealth. So, but here's what the banks don't want you to know. Like, you understand that most people listening to this have a W-2 check. It goes into the bank. And then from there, what happens to it, right? You put it in your savings account, you're paying your bills with it. It's just cash for the bank and they sit on it. Well, this is a liability to the bank. Believe it or not, when you put cash in the bank, it's a liability to them. They need to pay you 4% on your money now. And, banking's very different. But they have to go and lend it and get a spread on that money. So if they're giving you 4.5%, 5%, I don't know what they're giving you at your bank, they need to earn a spread, meaning they need to go and lend on cash flowing properties, real estate, cash flowing businesses, things like this. And they love really simple businesses that provide a lot of cash flow, and they can make a spread on the loan. So if they're lending to you at the 5% mark and you're earning the 5% mark, they need to be able to lend 7 to 8, sometimes 9%. Banks are sitting on very little cash right now and a lot of cheap debt. So understand that their average debt, which they probably have lots of mortgages that are under 5%, because what happened in 21, 22, when mortgage rates hit, rock bottom. But now they need to lend a lot of money, and they're being very cautious because they need more and more deposits. They need people like out in the economy putting more money in their bank so they can go lend again. But they make a lot more money when they're earning that spread, and that spread is very thin right now. So that's why you're seeing these high interest rates at the bank level. So why would they need, what do they want to lend on? What do banks love to lend on? They love lending on cash flowing properties, like I mentioned, things that appreciate, because what they hope that most people do not talk about is they hope you come back and take more loan, right? Like, they love appreciation. They love inflation. They love those types of things happening, because if you say you bought $1 million house and it goes up in value to 1.5 million over the next 10 years, and you come out, instead of, you're paying off your loan slowly, right, towards the principal, and you're paying all this interest, but they want you to go back and say, hey, I'd like to take 500 grand more out on my house, or 300 grand, refinancing your house, right? Typical process. You get that money out tax free. It's a powerful tool. But what the banks don't love is that it's always tied to your income, right? Like, that's why they only like to be exposed to the mortgage market. And most people get this part of it wrong. It's funny how people they'll invest into things like liabilities, cars, number one. That thing has zero chance going up in value. Now, I know there was a weird wave in 21, 22. That is not going to happen again, probably in our lifetime, maybe not. So, but they don't have cash flowing assets, right? Now, you can do things like Turo with your car. This is where you lease your car out to somebody, just like a short-term rental. And if you leased your car out for a week to somebody and you made $500 and your car payment was only $300 and your insurance was another 100, you'd make a spread, right? Like you'd make money on a cash flowing asset. That would be a good debt to have. That would be a good reason to have a car like that and be able to make the payment and it's cash flowing. That's good debt. And that's what most people, don't get about what the banks are trying to do and how you use the bank to your advantage. And I know most people, if they're listening to Dave Ramsey, they're going to say zero debt. And that's where actually they get it wrong. Dave's baby steps are great, but you need to leave his baby steps as soon as possible and start taking on good debt of some sort, right? And so this video is not about good debt or bad debt, but it's about using the power of leverage, which that's why banks are created, right? You want to make money with their money because they're willing to partner with you on buying real estate projects and different things. So instead of buying a house that's a liability or a car that's a liability, it's funny how much people will lose money at these types of assets, but yet they'll pour 70% of people's net worth are buried into their houses. And I would say the other 20% is buried into their car. They have their net worth in two liabilities that they have to make more money to pay the payment to hopefully just live a life that they're happy with. And so they're always tied to making more money and doing more work. And I'm talking about the 99% here, right? Like I'm speaking to everybody, almost everybody that would be listening to this. And most people want to escape this path. Well, to escape this path, you need to just, instead of investing in a big home, investing in fancy cars, use that money and invest into something that'll make a yield, and get yourself in debt. But I'm talking about good debt. I'm talking about where, let's talk about, I do luxury storage facilities. I build these facilities and fill them full of tenants. The tenants pay all the expenses on the property, meaning the heat, the light, the electricity, the gas, whatever it takes to maintain the property. And then over and beyond that, their money also pays for the debt. And they not only pay for the debt, but there's money left over after the debt, aka cash flow, right? Simple process, but it's so funny to me how many people would say that is too risky. That takes too long to appreciate. When 70% of the people, in this nation have debt on their homes and they got to make more money and keep paying into this thing. Well, if you can invest your money into a real estate asset and get a 15% return, which would be a modest, okay return in real estate. It's also much higher than most things like the stock market and other things. It's amazing because guess what's going to happen in 10 years? Like your property went up by, let's just say 1.5 times what, the $1 million property went to 1.5 million. Well, the $5 million property went to 7.5 million. Now what can you do? You obviously refinance, tax-free again. You're leveraging the property more, but you're putting more debt. And that's why my debt continually goes up. It's because the properties continually appreciate. And guess what? I get to take on more debt. But you know what? Taking on more debt in 10 years is fine as long as the cash flow is there, right? You don't want to over leverage the property where you're not going to have cash flow. The banks will stop you from doing this. The banks want some cushion between what the property performs or produces for income, meaning all the income and all the expenses from the property. They want a spread between how much debt you can take on it. They want to make sure you can support your payment. But having this understanding that it's just cyclical, right? Like in another 10 years, we're going to do that again. And instead of just having one house where we got to pay the mortgage, we can have the tenants pay the mortgage. And this is the simplest way that banks don't want you to actually know this. They want you to actually come lend, but banks don't want you to know that like using the system as it's supposed to be built. They want you to keep just cash. They love savers and they love borrowers. That's how they produce income. But in order for you to get ultra wealthy, you need to flip from saving into that borrowing category. You need to figure out, instead of solving $2,000, $3,000 issues, how do I solve $20,000 or $30,000 issues? Or how about $200,000 or $300,000 issues on big properties, right? And so if I'm speaking to you right now, like I literally started out from nothing and have really evolved into a real estate investor in doing luxury storage. I've done multifamily, I've done industrial, I've done all these different things. And I've learned that real estate is definitely a compounding tool. And now there's really three big things that you want to understand. And before I mention those three, I always get asked, like, should I wait? Because the economy's at a weird time right now, right? Like, well, the interest rate's going to come down. The Fed has said, yes, the interest rates are going to come down 3 times this year. So, but it's not a wait to buy thing in real estate, right? Like, you buy real estate and wait, but don't try to time the market. It's like, don't buy Bitcoin low and just, it's going to drop lower probably. And then it's going to move all over the place and it's going to spike and it's going to do all these weird things. Don't try to time it. Just try to get into it, right? Like, make sure the property is something you can afford and get the cash flow for. Maybe you can use creative finance and buy the deal. Make sure there's cash flow there, because guess what? When you get into a $500,000, $1 million property, when you get into these bigger properties, things are compounding much faster. Why? Because a secret thing called inflation, right? We know inflation is if you had $1 million in 2019 and you had $1 million today, the $1 million would only be worth probably $650,000. And so the people who got screwed in that deal is the savers. The borrowers, our debt went from $1 million pre-2019 to now $650,000 in today, right? Like, it's dramatically different. The purchasing power of the dollar, it doesn't go as far as it used to. And that's the power of inflation. Inflation is going to be around, I believe, the 3-4%. I believe how they're reading today is not anything close to what they're actually describing on paper. They say 2% is the target. I don't believe that it's at 2%. I think money, I think everything's costing a lot more, a lot faster than they even anticipated. And I think it's going to be like that for a long time, the next decade, because of all this cheap debt that got taken out in 21 and 22. But really the three main things that you want to buy for, if you're looking for a real estate deal, or you're like, hey, this speaks to me. How do I get into this? What do I do? If you're just going to go and buy real estate, like, the general location is like, always buy for location. Even if the property cash flows less, I promise you, if you buy for location, you will get a better appreciation play. The property will perform even better. Don't go buy cheap. Don't go buy a wrong location. Don't go buy the wrong property asset. I do luxury storage. People invest with me passively. I do everything for them. But I also teach people how to go and buy their own storage assets, how to go buy their own real estate. And so buy for location, though. I promise you, of all the assets that I've bought in cheap, I've bought in bad locations, I've bought in really good locations, I've bought in a really good asset type in a good location. And it always happens to be that the best locations always have the best exit strategy. And when you have predictabilities, banks love good locations and they're your biggest partner, going to be your biggest lender one day. So understand that and play the game as it is. But number 2, make sure it cash flows, right? Like, no matter if you buy $1 million property and you got to come up with $300,000 and you come up with a seller finance or a creative financing strategy, make sure after all that debt is paid, still make sure it cash flows. Give them price. Like, we'll buy in the best locations, give them the crazy price, but if it cash flows, it doesn't matter what the price is. Overpay for the property. Maybe you can pay $2 million for this property and you're like, yeah, it still cash flows great. And they're willing, if I give him $2 million, he's willing to like carry everything. Great. Maybe he's looking to exit. 10,000 baby boomers are retiring every day. They're trying to get out of their stuff and the millennials, my age, all these trying to figure out how to buy it because everything seems so expensive today. You got to figure out how to take debt and you got to understand how to underwrite, do cash flow, and you want to buy for cash flow. So number 3, you have to figure out how to use leverage to get higher returns. We figured out you buy a property that, for $1 million and you don't leverage anything. Okay, great. You earn 8% on your money. But now that you can use a leverage, you get to use the bank's money and use very little of your capital to provide a higher return because you're leveraging your profits, right? Like, that's what you're trying to do. And you get to also write off the interest on that loan. It's like, why earn it in cash when I can write off all these other things? And then guess what? I get to use depreciation. I get to depreciate an appreciating asset. Oh, guess what? You also literally will get cash flow because of the property you own, and you get to leverage it with a higher return on your money. Leverage is the secret to wealth, and one of the places that's holding most back from being savers or borrowers. So I want you to look at your situation. I know I looked at my situation 10 years ago. It was much different. Had all my equity in my house. House was paid for. I'm like, this is stupid. This is stupid. I'm like, everyone is telling us, like, go buy an asset where it actually like produces income. It's like everyone just wants to pay off their house or get a bigger house, leverage themselves up in a house and a car. And it's like you take those two assets away from most people and you know, turn them into good debt, meaning debt that's paid by someone else, a tenant, someone else that provides cash flow while you're also investing there. Don't invest all your money in your house. That's what I'm telling you. Like, don't invest all your money in your car. Save some money, invest in real assets, put some money to work, make money while you sleep. You've heard all this stuff before, but this is what the banks don't want you to know. They don't want to turn you from a saver into a borrower. There's less of me, the 1%, out there borrowing than there are savers, people that are putting money in the bank, and the bank's making money on the spread. So, guys, I hope you understood something of what the banks really don't want you to know and how to convert yourself really from a saver into a borrower. Listen to some of these concepts in here. I appreciate you all. We'll see you in the next one.